In this video, you'll learn which dividend stock I'm buying in May 2020 using the Freetrade UK app. I would like to note that I've changed the style of this video. It's a little bit different from last month's, as I want to include more research, but I'm not going to go into too much detail about the research. Instead, in an upcoming video, I'm going to show you how I research my companies and then just give you some raw data on the monthly purchases. However, the watch list monthly updates will not be changed. Disclaimer, I'm not a financial advisor. If you seek financial advice, please see a licensed professional. In the current investing climate, dividend stocks are becoming increasingly harder to find, at least in the UK market. Many stocks have suspended, slashed or cut their dividends, so it is a lot harder to find them. Not to mention the prices in the market are currently highly volatile, and in the last few days we've seen it swing upwards, but it would be foolish to disregard the fact that it could swing and crash straight back down. The panic that the media can create in such vulnerable times means that some investors are listening to the news and panicking. They might be buying or selling regarding what they hear in the headlines. And this isn't great. Also, the neighbour's dog. Cheers. Yeah, thank you. Shout out to the neighbour's dog, eh? However, we as long-term investors know that this is one of the worst decisions an average investor makes over their investing lifetime, as they are likely to sell when they see a considerable drop in their money, say 30%, and then they won't buy back in until they see the stocks rise again, which means they are missing out on all of the potential gains. Ladies and gentlemen, boys and girls, please allow the neighbour's dog to take over the rest of the video. Round of applause, please. No, you don't want to talk now? Alright, I'll do the video, yeah? Cheers. And when they see their money lose a considerable amount, they usually buy back into the market once the price has already risen. And they end up losing a lot of money this way, and it leads to a very vicious cycle where the investor thinks they're doing well with their money, but in reality they're just losing more and more. This month in particular, I'm looking less at a dividend yield, more of a dividend with security. I'm looking for a company that can provide me defensive dividend yield, but will consistently keep their yield, or they'll keep their dividend throughout tougher times, or even grow it. So in May of 2020 in the UK, which stock will I be buying? The company is in the consumer sector. They sell certain alcoholic beverages. And if you haven't guessed already, the company is Diageo, not Diego. I messed that one up on the last watch list video. And I did, as I said, mention it in a previous video, and I'm very happy with how they are. I've done further research on the company, and I will do a video on future about that process. I feel that the company has certainly in recent news improved. Whilst they have a low dividend yield of 2.6%, their payout ratio is only 53%. Which means they've got room to grow and expand it. So over the course of my long-term investing, they're likely to continue growing their dividends, which means in the long term, I'm going to be earning even more money from them. And this allows them to consistently improve their dividend without worrying too much about eating into too much of their profits. And in the next few years, they do aim to reduce that whilst increasing the dividend. And in fact, this company has managed to keep their dividend for 20 plus years. But it gets better than that. They've managed to grow their dividend consecutively for more than 20 years. Now that is amazing, as that's lasted through the dot-com bubble of early 2000, where there was high unemployment, lots of jobs lost, a loss in revenue for the company for sure. And they continue to grow their dividend by an average of 5% year on year. Also, the greatest financial recession in our recent history has meant that they've also kept paying their dividend, even though the markets at that point were extremely volatile, selling off, and it was a very, very tough era for a lot of people. Diageo continued to pay their dividend. And this is a company that you would add to a dividend growth portfolio, because you know that even in the toughest of times, they will continue to pay their dividend. And a lot of people would say you'd be paying a premium for this company, and yes, that is true. Their price to earnings ratio means that they are considerably higher than their industry and their market, but I believe you pay a premium for premium quality of stock. This stock will, I believe, perform better than some of the cheaper stocks that don't have as high of a price to earnings ratio, but still believe that this stock is the stronger contender. You may think, well, if I buy a cheaper stock that's got a lower price to earnings ratio, surely I'll get more growth. Well, maybe. However, this stock in the last 5 years has managed to outperform the Ftse 100 by 70% without dividends reinvested. 70% of capital growth. Now that is incredible. And if you're interested on how I research my companies and how I bring together the dividend monthly purchases and watch lists, click the subscribe button, because upcoming in the next few days I'll post a video on it. Why have I gone for Diageo and not other companies, maybe more valued companies, as this company is only 2.2% undervalued according to Simply Wall Street? And that reason is because of how they react to these situations. I believe that their business and their model means that they are very defensive in times like this. Recently, and by recently I mean the 28th of April, which at the time of recording is yesterday, they raised the capital of 2.5 billion by selling bonds, and that was so they could strengthen their liquidity, allowing them to avoid more risk during this potential crash or recession. And this is the defensive kind of moves I look for. I don't want all the companies in my portfolio to get over aggressive, over leverage, because that presents a lot of risk. And with that amount of risk they take, they might not necessarily be getting the reward behind it. Sure, you've got the term high risk, high reward, and that would apply in some situations, but some companies they're likely to fail. So you do want stocks in your portfolio that are defensive. They don't play too aggressive, but they still grow year on year by an incredible amount. And these defensive stocks, the downside is you won't see too much value. You won't be able to get it for cheaper than the market, as they don't have as high volatility. It's also worth noting they've also halted their share buyback scheme, and they did that earlier in April. And this also again allows them to strengthen their liquidity. They're defensive, they're ready for the situation to occur. If worse comes worse, they have to shut down all their factories. They've now built up a strong cash position that they're weathered ready and will probably continue paying their dividend. And that's why I've chosen Diageo. Thank you for watching. I'm Osborne Foreman, and that's the neighbour's dog. Have a good night.